Today is March the 17th, 2026. We're going to do a deep dive today on March the 17th, 2026, in case that got cut off. Going to do a deep dive into three companies that are kind of leaders in their markets: TJ Maxx, Ross, and Burlington. So I'm going to talk about these for a minute. And first of all, disclaimer. I actually do own shares of TJ Maxx. I bought some, or TJX anyway, sorry. I can't help but call it TJ Maxx. And throughout this thing, I can't help but call them TJ Maxx, Ross Dress for Less, and Burlington Coat Factory. Unfortunately, I call them those three things. There's almost nothing I can do about it because that's what I've seen, even though it hasn't been called Burlington Coat Factory for a number of years. So I actually own shares of Ross, and the reason of TJ Maxx, and the reason I'm doing this is my wife actually is thinking about buying some Ross stock because it's forming a base. Investors Business Daily pointed that out to her, and she asked me to do the deep dive this week on these, and so I kind of put everything else aside and decided to do these particular stocks. Other disclaimer: nothing I say on here is investment advice. I am a hack at best. This stuff amounts to conversation in the booth at Waffle House. It's not even good quality financial analysis. So I have spent my career bumping up against a bunch of these things, but am none of these things, particularly an accountant, a financial analyst. More than anything, I'm an appraiser and a valuer. So there we are. So those things aside, here's what we're going to do. I'm going to go into the world of off-price retailing, and I'm going to start with kind of an overview. There's a lot on this chart here, and I was taught in corporate communications class in the MBA program at the University of South Carolina that you're not to put a slide together and then read everything that's on the slide. That's really poor presentation, and that's true. So what I'm going to do is I'm just going to say here's the market capitalization, assets, and sales for each of those three companies. What should jump out to you is that TJ Maxx is absolutely the largest U.S.-based off-price retailer with $173 billion worth of market capitalization, a large number of assets that exceeds that of these other two, and a large number of sales that exceeds these other two. This is a hallmark of being the leader in your industry, especially over a certain break point. And I don't know what break point that is, but if you'll notice, TJ Maxx and Ross's debt is all standard fixed interest rate debt. Whereas that for Burlington is absolutely not. It's actually a combination of a floating loan and convertible bonds. And there's a reason for that. Notice that they have a market capitalization of about $19 billion and less assets and sales, whereas Ross is in the $67 billion area and TJ Maxx in the $173 billion area. When leaders in a market, especially leaders who have really great profitability, to the victor go the spoils. That's the way it works. And those spoils come down to better debt access, better debt terms, and especially if you manage your capital structure very well, you'll end up with people who want to lend you more because you simply have the headroom to give. Just to give you a very, very brief, not very comprehensive overview of their operations, TJ Maxx has a bunch of different divisions: Marmaxx, Home Goods, TJX Canada, TJX International, and they have all of these different types of stores in all of those different places. They also own a 49% a joint venture in multi-brand outlet stores, which is in Mexico. They recently acquired that, and not written here, but in the financial statements, it says that they actually have the ability to increase that over time. So they may actually be looking to expand more into Mexico, and there's a lot of opportunity in Latin America if you pick and choose correctly. And Mexico probably is one of those places. They also own a 35% minority position in Brands for Less, which is in the United Arab Emirates and Saudi Arabia. So you need to know, I'm not going to read all this over here. Ross only has Ross Dress for Less stores, and they have a second division called DD's Discounts. DD's Discounts, interestingly, there are only three. I had to look them up. They didn't even tell me this in the financial statements, but there are only three of them. There's one in Northeast Columbia, South Carolina, one in North Charleston, South Carolina, and one in West Charlotte, North Carolina. Intriguingly, to the two places that I spend virtually all of my time. Barasu and I travel back and forth between the Nashville, Tennessee area, and we have a second home in the Myrtle Beach area on South Strand, they call it. And so, intriguingly, they only have three DD's discount stores, and they're in Northeast Columbia, South Carolina, North Charleston, South Carolina, West Charlotte, North Carolina. That must have been an acquisition for them, I'm guessing. I don't know. I didn't have time to look into it, and it wasn't particularly important anyway. But they don't have any joint ventures. If you were investing in Ross, you are investing entirely in off-price retailing in the United States and its territories. They do have some stores in Puerto Rico and Guam and other United States territories. Burlington is considerably smaller. Burlington has one division. It's Burlington Stores. They used to be called Burlington Coat Factory. They dropped that a while back. It was kind of a fun name, but it kind of dragged them down because people thought they only retailed coats. Originally, back in the early 1970s, they did for a few years only retail coats. But by the end of the 1970s, they had spread out into all of the other home goods and ladies apparel and men's apparel and children's apparel and shoes and things that all of these different off-price retailers buy and sell, buy in bulk and sell at retail. I thought this was a curiosity. Right down here, by market capitalization, Burlington is 89% smaller than TJX and 72% smaller than Ross. But it's not necessarily that much smaller in assets and sales. In some cases, it's significantly less small, I should say. It is smaller, but significantly less small in sales and assets than it is in market capitalization. So in a way, Burlington has somewhat been overlooked in the market. You're going to find out why in a minute. And it starts with the floating loan and convertible bonds issue. They simply don't have as good access to capital as good a terms as these two market leaders over here do. They're just simply bigger, and to the victor goes the spoil. That's the way it is. Success begets more success. Failure quite often begets more failure. If you can have a bit of success in the middle of your failure, you can start a turnaround because enthusiasm begets enthusiasm. It's all human nature. And so that's kind of the way that works. And so Burlington is doing what it can to try to keep up with its big brother and big sister over here. Interestingly, I went to look this up. There is absolutely no correlation whatsoever between how big these store brands are and how long they've been around. I'm real bad to go down a rabbit hole. I'm pretty sure that I have ADHD, and I love reading about nonfiction stuff because to me, life creates enough interesting stuff that I never have to read hardly any fiction at all. There's almost no correlation. It's not like TJ Maxx or TJX is bigger because they've been around longer. That's not really it at all. Basically, these three stores just simply had different fortunes at different periods of time. And so their growth has been a bit different. Their market capitalizations, assets, and sales are now a bit different, but it really doesn't have a whole lot to do with how long they've been around. I've pulled these up on a quick scan here, and there are a lot of numbers here. I don't expect you to go through all of these numbers with me. I just want to point out a few things. So do this. Kind of shut your brain off for a minute. Don't look at all the numbers and just kind of look at a couple of trends that I point out, if that's okay. You can see over 10 years, I'm going to start with TJX. TJX starts with about 1,292,000,000 shares and then slowly decreases those shares all the way down to 1,125,000,000. It's a slow decrease, but look, I like to know that my stock is a store of value, at least. And if they buy back shares and control their capital stack in that way, I'm all for it. You can also see that over 10 years, their gross profit ratio grows from 29%, takes a little bit of a dip here, and then ends up around the 31% range. That's good. That's improving profitability. Kind of the same thing happens with the operating income ratio, 12, 11, and then we end up at 12 again. So at least good stability right there. Net income ratio, also stability and a little bit of improvement, 7, 7, 8, 7, 7, 8. Now we're in the 9% range. I'll come back to those in a minute. This line right here, if you pause the video and you look at debt to assets for each one of these, you'll notice that in most cases, in these earlier years, they have a much lower looking debt to assets. They did not take on a ton of debt. There was an accounting change. And without going completely into the weeds on the accounting change, the Financial Accounting Standards Board decided that in some cases, companies were using assets. They were leasing them, but they were using assets so long that essentially they were taking their entire useful life. And so instead of just calling them operating leases, they needed to call them capital leases. And that put it in the debt area on the balance sheet. So when I see a company that has a big jump like that, I have to go dig into the balance sheet. I have not concentrated much in this video or any of my analyses on debt to assets. Instead, I'm interested more in their interest coverage, which I'll talk about quite a bit. In the last 8 quarters, TJX continues dropping your share count all the way down, covering their interest very well. You can see, I mean, when you cover your interest at 73 to 100 times with your EBITDA, you're doing pretty well. That is a low risk situation. And so you can see their fundamentals, anything from stay steady to improve, depending on how you look at them. ROST kind of looks the same way. Their gross profit ratio actually held steady, whereas TJX's kind of improved just a little bit. Operating income ratio kind of stays steady, maybe declines just a little bit. And net income ratio steady, maybe even declines just a little bit. Interest coverage, though, was a lot higher several years ago, then dipped, and now is improving again. ROST is kind of right in there with TJX, but probably just not quite. It's a second, and there's a reason it's second. Where that comes from, I don't know. We will stack these up against each other in just a minute, so hang tight on that. This is a bit of bad data. Every now and then, I use a company called Y-Sheets to provide my data aggregation, and every now and then, and if it happens, it's almost always in the very last set of data, probably because it hasn't been really corrected and looked over yet. There'll be a bit of bad data. No, it's not like they're not covering their interest. It's there. It's just, but you can see in the last 8 quarters, you can see their interest coverage improved 30, 41, 53, 48. And this is in an era when interest rates have risen, and Ross is probably fighting an uphill battle. You can actually see their debt to assets decrease 41, 40, 38. Bearing in mind, of course, that a lot of that's going to be capital leases, but decreasing 41, 40%, 38%, 35%, 34%. If we go back to TJX over the last 8 quarters, 41%, 43, 39, 37. I don't think that that's a bit of good data. So same kind of thing. They're maintaining their and very good interest coverage. They're maintaining their capital stack. Now let's go to Burlington for just a second. Here is 10 years of Burlington. Now, point about Burlington. In 2013, if I remember correctly, Burlington IPO'd for the second time. There was a family in New Jersey that started Burlington. It was called the Burlington Coat Factory because originally they bought a warehouse and sold coats out of it. Then they, by the end of the 1970s, that was about 1972, I think it was. Then by the end of the 1970s, they sold other items, and then they grew. And then Bain Capital bought them out in the mid-2000s, held them for a while after their first IPO. And then Bain Capital IPO'd them a second time in, I believe it was 2013. So you get this unavailable stuff up here because there's some wonky stuff to it. It's still the same years down here. My 8 quarters works. But you can see the weighted average shares decrease slowly. You can see the revenue increase slowly. You can see their gross profit ratio at least hold steady, if not increase a little bit. Operating income ratio increase a bit. Net income ratio kind of holds steady. So not a lot of worry here. The interesting part, though, is how their interest isn't covered at the massive number of times that TJX and ROST cover their interest. It's covered well. Understand, there are tons of companies that we could pull up that don't cover their interest. A 1 means you're covering it one time with all of your EBITDA. They're covering it, on a bad year 6 times, good year 15 times. And so here's the 8 quarters. I mean, quarter by quarter, you can see them cover the interest. And then if that's a bit of good data, they cover their interest better and better as we go. But you do need to know that they don't cover that interest at 75 and 100 times like ROST and TJX do. So that's kind of a quick scan overview. I'm going to come back to a few of those things in just a minute, but that's what we're working with as far as those 3 companies are concerned. Burlington is significantly smaller. It does not have as good access to capital as its big brother and sister do. And if you invest in TJX, you are getting diversification in that you are investing internationally as well as nationally. With ROST and Burlington, you are actually only investing in off-price retailing in the United States. So it depends. That's an interesting point before I move on, because right now, with the whole tariff thing that's going on, and look, mercantilism is not a new idea. Mercantilism came along at the back end of the Middle Ages, and mercantilism is basically, without getting too far into socioeconomic philosophy, mercantilism is basically emphasizing your own country's power through protectionism, making sure that you have a positive trade balance all the time. Mercantilism is very, all this tariff stuff and things. This is all mercantilism. The problem is all of these philosophies are not new. People act like it's the first time anyone's ever come up with them. But really what happens is none of us live long enough to really have the experience to know whether or not they work and what works best. And so don't think for a minute that closing off trade and all that is, and trying to increase your economic power by restricting trade with other trade partners is a new idea. It's not. Now, the level 3 of the CFA program teaches some models. The one that I remember the most is the Singer-Terhar model. And without getting into math and again, socioeconomic theory, the idea is that when you close off trade, the world's resources are not evenly distributed. And no country has really an optimal mix of all of the world's resources. And so when you go closing off trade with trade partners, you actually raise the cost of capital, which decreases the value of assets. There are enough people out there these days that have had that training that they know that that's the case. And so that's why last April, when we had just this, tariff drumbeat going on and it was loud, that's why the stock market sold off, and the bond markets too, because the cost of capital, the outlook for it was rising. If you invest in TJX, you actually are investing internationally. While the United States has been doing this mercantile type lean, the other countries, Europe, South America with Mercosur, they have, I think there's a Middle Eastern and North African one too. And what they're doing is they've been creating and strengthening trading blocks among themselves in order to lower their cost of capital. So a lot of the thinking has actually been sell America, especially since over the last 15 years, since the end of the Great Recession. The United States has had such an imbalance of positive economic power versus the rest of the world that another part of the thinking is that the rest of the world might need to go ahead and catch up. And we've actually seen foreign indexes in stocks catching up with the United States and even outperforming the S&P 500. A lot of that is the outlook based on, the premises of the Singer-Terhar model. So if you invest in TJX, you are investing internationally. With ROST and Burlington, you are not. And you're also investing in a company that has extra power as far as getting really good financing. So that is to be considered. Okay, these are some things that really stood out to me, and I want to talk about this. First of all, I'm going to stop right over here. We know that consumer sentiment is actually not great. This March reading here is 55.5 points. It's an index that's kept by the University of Michigan, or announced by the University of Michigan, and their statistics that are pulled by them. You might think, well, okay, it's kind of been rising a bit. Yeah, well, okay, let's look at 10 years of it. Consumer sentiment is actually not all that great at the moment. It's an index, and it's calculated as an index. So it's not like 55% of Americans think that the consumer market is good. It's an index based on a point in the past. And so here we are with the consumer index down. It's just a measure to tell us that we know that right now consumers in the United States, at least, and probably worldwide, are pinched. Inflation has not been great. It is coming down, but price levels are still up. Wages really haven't kept up with it. Wages will eventually probably keep up with it. The problem is we've got this double whammy now. Now we have AI and a soft job market. And so if wages stay stagnant, but price levels are now higher, consumers are going to be pinched for a while. That is a bad thing if you are, say, Publix, and you are at the top end of the grocery world. It's a good thing if you are Walmart, because the people that were shopping at Publix will put sunglasses and a low-billed hat on, and they'll go down to Walmart and they'll buy pretty much a lot of the same groceries that they were buying at Publix with their noses in the air about 2 years before. So there are retailers that profit from this type of situation, and off-price retailing is one of those. essentially these companies that we're talking about today, they hold this unique place in the retail ecosystem. I wish that was my own material. It's not. There was an analyst that I heard say that recently, and so if you're the guy who originally said that, um, sorry, props to you. I don't remember who it was, but they hold a very significant place in the retail ecosystem because what they do is they meet better quality goods with stretch income money, and they just meet supply and demand right there at off-price retailing. You can pick up good quality shirts, sometimes name brand stuff, at these stores, and most of the time it's 6 months past being the peak of fashion, but the people who are buying it there think it still looks good and really aren't trying to be the most fashionable guy at every dinner party. In fact, they're probably not going to a ton of dinner parties. I myself buy shirts and things. My wife buys skirts and shoes and all kinds of stuff at these kind of places because we're always looking for a deal. We always have been. And but in this kind of market with consumer sentiment down, these stores absolutely stand to benefit. This is some stuff that stuck out to me, and some of these are a little bit off the wall. This first one, okay, it just so happens that TJX actually manages its cash balances. So with them, Ross, Burlington, with these stores, they make a lot of cash and they put it in the bank, and it's because they're selling a lot of items. My grandfather had a saying. He said, if you manage your pennies, your dollars will take care of themselves. When I broke into this data, this is out of their annual reports. When I broke into these, TJX and Ross, what they're doing just totally appealed to me. They're getting income, short-term income, off of their cash balances from the sales that they get before they need to go use that cash. And then they also pay interest expense on their long-term debt. It just so happens that each of them, TJX and Ross, are actually getting somewhere in the neighborhood of 3 times the amount of interest income off of their cash balances than they are paying on their debt. And that debt is good quality fixed income debt. Burlington, not so much. Burlington is actually getting some interest income, but it's a little less than half of what they're actually paying on their debt, which is a mix of variable and convertible debt. So not as good a quality debt to them. It's probably beneficial to someone who buys their debt because I don't think that they're not good for it. It's just that they, TJX and Ross are simply taking care of their pennies and their dollars are kind of taking care of themselves. I love that. I thought that was really interesting. All right. Remember what we had a ton of numbers on the sheet where we did the quick screens. These are some things that stood out to me. If you take the last full year and you look at these ratios, it's interesting how Burlington's gross profit ratio, gross profit is simply all of your sales minus the cost of goods sold, what it cost you for the stuff to make those sales. Burlington has a 40% gross profit ratio. So their gross profit after they buy the stuff and sell it to the public is much higher than it is for TJX and Ross. However, in order to get that sold, one of the expenses in your operating expenses is SG&A expense, selling general administrative expense. I'm guessing that's what it is. For some reason, to get that sold to the public costs more than it does for the other two. And so by the time you get to operating income, Burlington actually turns less of an operating profit than TJX and Ross do. And that's based on revenue, not the next step down. So they're actually making more gross profit, but making a lower operating income, and their net income ratio then is lower than TJX's and Ross's is. Their interest coverage is also a fraction of what TJX's and Ross's are. This is the last closed year I have for TJX and Ross, and this is the last closed year I have for Burlington. It's not like that's bad for Burlington. It's just that TJX and Ross simply roll in money, and Burlington simply has what it takes if they need to replace an HVAC unit. If we were equating this to your own personal home expenses, this was very interesting. All right, FCFE, FCFF. Those are free cash flow to equity and free cash flow to the firm. Using the Wise Sheets aggregated data, I have my sheet calculate these things. And over the 10-year period that I track when I'm doing evaluation of a company, TJX and Ross, and I got rid of all the decimals because I just didn't want stuff lost in the. I wanted to lose things in the rounding on purpose. That's what I did. So between TJX and Ross, their compound average growth rate (CAGR) for both free cash flow to equity and free cash flow to the firm are about 12 and 9%, and their dividend grows as well from between 13 and 14%. There are going to be some decimals in there. Like I said, I purposefully got rid of the decimal points. Burlington doesn't pay you a dividend. Burlington actually has a negative growth rate on the free cash flow to equity, and it's severe. And they have a negative free cash flow to the firm. Now, there are a lot of things that large adjustments that go into free cash flow to equity and free cash flow to the firm. To me, though, if your free cash flow to the firm growth rate is negative over 10 years, you actually can have a negative free cash flow to equity percentage. And a lot of it will be because you're doing various things like paying off debt. But if you have a negative free cash flow to the firm over 10 years, that's probably not great. And that's underneath the surface. I think the world is continually, like, take a look at this. So here's TJX for a year, goes right on up. You can see it there. Just goes right on up. Here's Ross for a year, goes right on up. Here's Burlington for a year, goes right on up. Now, did you notice, though, that Ross and TJX seem to go up in a much smoother line than Burlington does? Burlington has a tendency to do this sort of thing. In my mind, if you were a wily veteran trader, Burlington is probably something that you're interested in, except for the fact that they do have the negative compound average growth rate in their free cash flows. That's not great. But as far as trading is concerned, you get more swing out of it. So if you're a swing trader, you're looking at Burlington and you don't care so much about TJ Maxx and Ross. If you are somebody who works all day, really for somebody like me who runs an appraisal company and does it for many, many hours of the day and even sometimes across the weekend, probably you're putting your money in TJ Maxx or Ross, depending on whether you want to be diversified internationally or if you just want to invest in the United States strategically over longer periods of time. And you're not worried as much about Burlington because Burlington has these swings and it's not quite as appealing to you. That situation, this last table right here, is illustrative of what I'm talking about. If you take, okay, ATR is average true range. It's a technical indicator. And if I get this right, it's done over a 14-day look back period. If you just bring it right out of the box, you can change that. But it's the difference it's the bigger difference between either today's open and close in price or yesterday's close and today's open. I believe I got that right. So if you, and it's a measure of how much in dollar terms that stock will move on average over, if you leave the defaults the way they are, a 14-day period. The gentleman that invented it was a guy named J. Wells Wilder Jr., I believe. And it's widely used these days. If you take the ATR as a percentage of the share price, which as of about an hour ago, when I put this table together, and you divide the ATR, you divide the share price into the ATR, you can actually see TJX has a 2.1% ATR as a percent of the share price. ROST is similar, but Burlington is considerably higher. Now, just so you know, I have found, this is just my experience, that an ATR of below 5 is reasonable to work with. From about 5 to 10 is pretty elevated. I kind of have to nail the entry. Above 10 is a stock that's just a bucking bronco. It's going to be really hard to deal with. Some people are really good at trading. I am moderately decent on a good day, and on a bad day, I look pretty bad. So, and that's after all the education and work I've put into it. I don't know who's really good at trading. I'd love to, Mark Minervini, I guess. But so these right here, this actually shows the doubt of the market in Burlington. Everything goes one direction, Burlington follows it. TJX and ROST do too, but not nearly so much. Those are things that really stood out to me. And then we need to go to this very last table. All right. I didn't run an actual valuation of the shares. It's not really as important as what these multiples are. Now, again, there are a lot of numbers on this sheet. Let me just talk you through a few of them. Don't zone out here. These are really, the trend is almost more important than the actual valuation of the shares. And I don't even go into an actual valuation of the shares, but over the last 10 years, and again, so 2017 to 2026. Now, the last video I put on here was Fubo. I did a 2-part Fubo video, and my man Matt Taylor and I went back and forth a lot over that Fubo video, and then we started going back and forth over TJX, ROST, and Burlington. Matt, if you're listening, you have an incisive mind. It's really, you do some really great points and some really great questions. Matt's point on these companies was, I'm afraid they've gotten a little overvalued to the point that they're probably going to stall. And I mean, I'm probably putting words in your mouth, Matt. Sorry, but I think that was your point, was that they've gotten so overvalued that they're going to stall out. Well, all right, there is some truth to that, yeah. With Fubo, which has negative EBITDA most of the time, just now has positive EBITDA and is in an industry that regularly has negative EBITDA, you can only value that based on a price to revenue multiple. I told Matt this, when I flipped over from working on Fubo to working on these companies, it was like throwing the window open and having some fresh, good smelling air come in, and the sunshine finally hit the floor for the first time in a week. And because we're not doing a Fubo video here, but Fubo's capital structure is complicated. These are not. It takes me about 60 seconds to wrap my head around what TJX, ROST, and BURL are doing when I look at their financial statements. Now, I will say this, they don't all give you the same information. TJX has a tendency to give you a lot of information in their financial statements broken down by business segment and things like that, but they don't give you as much by business line. ROST has a tendency to tell you literally what percentage of shoes versus ladies apparel versus men's apparel versus children's apparel versus housewares. They have a tendency to tell you all of that. Burlington's not quite as forthcoming with a lot of those extra tables and things. All that's legal, by the way, outside of just a few accounting statements and things like that. You're kind of on your own as far as what you want to display to the public. You want to display enough as a company to tell the public what you'd like for them to know so that they consider buying your stock. And yet you don't want to give all of your trade secrets away. And so there's a give and take there. But here's TJX on the top. So, you know, with companies like this that have positive EBITDA in an industry that routinely has companies with a lot of positive EBITDA, you can actually value it by both revenue multiplier and EBITDA. And the point I'm trying to make is this. Back here in the 2017, 2018 era, which is solidly in the post-Great Recession era, but also solidly before the COVID era. COVID era begins right here between 2020 and 2021. And the Great Recession's many years before this 2017, 2018 era. You're getting a low and a high revenue multiple for TJX of 1.6 and 1.3, 2 and 1.3, 2 and 1.5. Out here in the last few years, you're now paying upwards of 3 and 2.2 and 2.8. So yes, by revenue multiplier, the valuation has gone up. EBIT does the same thing. 11.8 on the high, 9.7 on the low, 15.5 on the high, 10 on the low. All the way out to now where we're paying 21.4 and 19.6 on the low. So yeah, the market's paying more for these companies. They've also grown. ROST same way, 2.6, 1.6, 2.8, 2. You're now out here 3.1, 2.6. So the market's paying more for their revenue. EBITDA 15.998, 16.8, 11.9. Now you're out in the 19s and the 12s and 16s. So yeah, they're paying more for ROST. Burlington has a price to revenue back here in 2017 of 1.6, 1, 2, and 1.2. Now 1.9, 1.3, 1.8, 1.6. The lows kind of moved up a little bit. Kind of. I mean, this is in the aftermath of the outbreak of the pandemic. It's lower than back here. These are in the aftermath of the pandemic. They're comparable to back here. There's a bit of a rise, but you really almost have to squint to see it with Burlington. And I think what that is, I think it's that the market knows that the growth simply isn't there in Burlington that has been there in TJX and ROST. I think that's what you're up against. A bit the same way, 15.9, 9.7, 17.9, 10. Go out here now on a price to EBITDA level, yeah, there's a 19.1, 12.9, but this year 16.8 and 14.6. Those actually kind of, I mean, the low is higher here, but the 16.8 reasonably comparable to the high over here 10 years ago. So people aren't paying as much for Burlington because they simply aren't. They simply aren't seeing as much growth in Burlington. But like I said, if you are a clever trader, Burlington is probably your domain because you have upward price momentum in the shares and you have larger swings. It just moves. Now, last minute, what do I think? Every CFA question seems to begin with an investor believes that, and then you end up figuring out what to do based on what the investor believes, but they don't spend a whole lot of time teaching you how to believe what you should believe. Probably to their credit, but I would have liked a little bit more as to what to believe. I personally believe that with the atmosphere the way it is right now, you probably want to invest in a diversified way with an international presence to it. So to me, I'm a bigger fan of TJX than I am ROST, and I'm definitely a bigger fan of TJX and ROST than I am of Burlington. I'm not, I try a bit of swing trading. Sometimes it works, sometimes it doesn't. But I'm the kind of guy who runs a company and I like to find some things that I can put my money in and look up 3 months from now and I have green numbers sitting beside my red numbers. I don't like, I'm beside my black numbers. I do not like to see red numbers sitting beside my black numbers. I want to see green numbers beside my black numbers. TJX, in the last little bit, just to give this idea, here's the S&P 500. We come out of the tariff tantrum, as many have taken to call it. It runs high, and then right now we're doing this process of backing off and then relief rallying and backing off and relief rallying. I would highly recommend that you watched Dave Keller's market misbehavior videos. He does a free one every single day. Get on YouTube, Google market misbehavior, and watch his stuff. I will try to tag him if I can. Dave is fantastic. I have taken to not doing nearly so much market overview stuff because he's so good at it that I just don't see how I could add other than to just direct you to marketmisbehavior.com. Instead, I think I'm going to spend most of my time talking about individual stocks, sectors, parts of stocks, how they compare, relative strength once I get to it, that kind of stuff, individual things, trying to beat the S&P 500. And I'm just going to leave macro analysis and market overviews to the likes of Dave Keller, who are just better than I am at it. But you can see, just, I mean, here's the market rolling over, so to speak. And maybe it's going to come back, maybe it's not. Today and yesterday were better days than the days before. But it looks like capital is being pulled out of the market. And so if I'm looking for things that will beat the market, I'm probably looking for things. I know these are priced kind of highly, but for me, TJX is the way to go. And the reason is because of the international diversification. Remember, mercantilism has the ability to raise cost of capital, which sends asset prices down. If trading blocks are being built and strengthened in other areas of the world, and if other areas of the world have lagged behind the United States in the past 15 years, and they're catching up now, you really kind of want to be diversified and probably don't want to just invest directly in the United States. That'll flip again. There will come a day, look, political regimes change. Perhaps the party in power doesn't change, but the people in the party who are in power change. We don't know. We don't know what's going to happen. But for right now, just with the outlook and the few years we have coming ahead, I'd be internationally diversified. That's what I think. So thanks a lot for listening to me. I would really, really appreciate it if you watch this. Please subscribe to my channel. There'll be a lot of these. We're going to do weekly deep dives into stocks. Those were easy, so I could do 3 at a time. We're going to do penny stock spotlights because I really love to get in the weeds on things like that. And we'll have the weekly 10 Mil Club meeting. Weekly 10 Mil Club meeting used to be a lot longer. I'm probably going to eliminate a lot of the macroeconomic stuff, just direct people to Dave Keller and the like, and then talk about individual stocks and things I'm looking at. So please consider subscribing. Would love to hear from you. Matt, thank you for all of the questions and discussion and all of that. And now that I've finished this, I've been quiet for about the past 12 hours because I've been working on this. Now we'll be able to communicate a bit more. And, because I get into the throes of putting this together, and I just don't have a whole lot of time to really talk back and forth. So you'll hear from me here pretty shortly. Thank you so much. We'll see you on the next one.